Investing in the right financing. How do you get the right debt on a deal?
The average person looks at a mortgage and sees a 30-year burden, a necessary evil to own a roof over their head. The wealthy person looks at that same document and sees a weapon. This is the fundamental divide in how money is understood. For most people, debt is a symptom of not having enough. For the financially literate, debt is a tool for acquiring assets without using your own money, a mechanism to make your capital work harder. This tool, in its most potent form, is called leverage, and without grasping its mechanics, you are not just missing a piece of the puzzle. You are blind to the very engine that drives modern wealth and power. To understand leverage, you must first abandon the moralistic view of debt. Consumer debt, the kind used to buy a car that depreciates or a television that provides immediate but fleeting satisfaction, is a wealth destroyer. It carries high interest, creates cash flow drag, and buys liabilities. The leverage we are discussing is the exact opposite. It is productive debt, used to acquire an asset that generates income or appreciates in value. The principle is brutally simple. You borrow money to buy an asset, and if the return on that asset exceeds the cost of the debt, you pocket the difference. This is the alchemy of finance, the method by which a modest sum of capital can control a far larger empire of assets. Imagine you have $100,000 to invest. You could buy a property worth $100,000. If that property appreciates 10%, you have made $10,000, a 10% return on your investment. Now imagine you use that same $100,000 as a 20% down payment to buy a $500,000 property. When that property appreciates by the same 10%, it is now worth $550,000. Your profit is $50,000, a 50% return on your original $100,000, all because you controlled the asset with debt. This is leverage at its most fundamental, and it is the reason why property developers and real estate investors can build fortunes far faster than someone simply saving their salary. They are using the bank's money to amplify their own gains. This principle extends far beyond real estate and is the lifeblood of private equity. A private equity firm does not buy a company with its own money. It assembles a pool of capital from institutional investors, like pension funds and endowments, and then, crucially, it borrows a massive amount of money to complete the acquisition. The debt is often placed onto the balance sheet of the company being bought. The firm then uses the company's own cash flow to pay down that debt. If the firm can improve the company's operations, increase its profits, and sell it a few years later, the profit is not split equally. After repaying the debt and returning the initial investment to their limited partners, the private equity firm takes a significant share of the remaining value. Their carried interest is not just a fee. It is a reward for using leverage to engineer a massive outcome from a relatively small capital outlay. They are not just managers. They are financial engineers where the primary raw material is borrowed money. The institutional world is built on this concept. Banks are nothing more than highly leveraged entities. They take in deposits, a form of debt they owe to their customers, and lend it out at a higher rate. Their entire profitability rests on the spread between what they pay for money and what they charge for it. An investment bank like Goldman Sachs uses leverage to trade and invest. They will borrow billions of dollars to amplify the returns of their trading desks and their own proprietary investments. A small movement in a market, a 1% swing in a bond or currency, can translate into a vast sum of money for a leveraged institution. This is not gambling in the way a retail trader might place a bet. It is a carefully calibrated strategy of using borrowed funds to maximize the return on their equity, a return that pays for the most sophisticated talent and systems in the financial world. When you hear about hedge fund managers like George Soros or John Paulson making billions on a single trade, you are witnessing the raw power of leverage. The legendary trade where Soros broke the Bank of England in 1992 was not a simple bet that the pound would fall. He used massive amounts of borrowed money to short the currency, controlling a position far larger than his fund's capital. When the pound devalued, his profit was a multiple of the funds he had committed. Similarly, John Paulson's bet against the subprime mortgage market was a masterpiece of leverage. He did not just buy credit default swaps. He used his fund's capital to secure contracts that controlled a staggering amount of notional debt. When the housing market collapsed, a small movement in the underlying mortgages was magnified into a profit of over $15 billion. The market psychology is key here. Leverage cuts both ways. A 1% move down on a highly leveraged position can wipe out your entire equity. The fear of this downside, of being forced to sell into a falling market, is what creates the panic and volatility that defines financial crises. This brings us to the most critical and often misunderstood layer of leverage, the creation of money itself. When a bank makes a loan, it does not lend out money it has sitting in a vault. It creates that money electronically, writing a new deposit into existence on the borrower's account. This is fractional reserve banking, and it is the foundation of our monetary system. The Federal Reserve can set interest rates, but it is the commercial banks that create the vast majority of the money supply through the act of lending. A mortgage is not just a document. It is a new piece of money injected into the economy, searching for a home, a car, or a business. This means that the supply of money is elastic and tied directly to the level of debt. A powerful institution like the Federal Reserve does not control the money supply in a direct sense. It influences its cost and availability, guiding the banking system's collective creation of credit. The wealthy have mastered this cycle. They understand that a dollar borrowed at 4% and invested in a business or asset that returns 10% is a net positive, creating profit from nothing but a contract. They are not necessarily smarter or harder working, but they are better attuned to the system's mechanics. The legal structures they employ, like family offices and trusts, are designed to manage this leverage, to protect assets from creditors, and to minimize the tax burden on the amplified gains. Taxes, after all, are a form of cash flow leakage. A savvy investor structures a deal not just for maximum return, but for maximum after-tax, risk-adjusted return. This is why ownership is so much more powerful than income. A high salary is taxed heavily and is a linear reward for time worked. A leveraged asset produces income while you sleep, and the capital gains from its sale are often taxed at a lower rate. The ordinary person sees the debt of a nation, a federal deficit of over $30 trillion, and feels a sense of impending doom. The financially literate sees that the U.S. government, like any large entity, can use its own leverage, its ability to issue debt in its own currency, to fund programs, stimulate the economy, and manage its cash flow. The true danger is not the existence of the debt, but the cost of servicing it. When interest rates rise, the government's own cash flow is squeezed, and that is when the system becomes vulnerable. This is why central bankers watch inflation and employment so closely. They are not merely managing the economy, they are managing the stability of a global financial system built on trillions of dollars of interconnected leverage. Consider the collapse of Bear Stearns and Lehman Brothers in 2008. These were not just poorly managed banks, they were massive towers of leverage that toppled when the value of their underlying assets, subprime mortgages, fell even slightly. They had borrowed so much money that a seemingly minor decline in housing prices was enough to make their debts exceed their assets. They could not raise new capital because no one trusted their balance sheets, and they were forced into bankruptcy, triggering a global panic. The Federal Reserve and the Treasury Department had to step in, not to save the bankers, but to prevent the collapse of the entire system of credit, a system so intertwined that the failure of one highly leveraged node could freeze the entire network. The lesson is not to fear debt, but to understand its terms, its cost, and its potential. The wealthy use leverage to buy time, to acquire assets that generate cash flow, and to build a portfolio that grows even when they are not actively working. They understand that a business is often just a set of cash flows, and they will use debt to acquire it if they believe the price is right and the cash flows are stable. They understand that cash flow is the oxygen of any financial system, and leverage is the machine that breathes it. The difference between the wealthy and the average person is not a secret handshake or a conspiracy. It is a deliberate, disciplined understanding of the simple arithmetic of borrowing $1 to make $2. It is a worldview where debt is a creation, a tool, and a form of control. When you look at a mortgage, do not see a burden. See an opportunity to control an asset, and, if you are careful, to harness its power to build a fortune for yourself and your family.